So, a few weeks ago, I posted a video all about dollar cost averaging. It's my preferred and favourite investing strategy out of all of them, as dollar cost averaging has even been shown to beat somebody who buys the most perfect dips. I did a whole video talking about it and sharing the data to back this up, so feel free to watch it. I'll put a ribbon somewhere here. But today I'm here to shed some light on a new strategy which is claimed to beat the almighty dollar cost average. So in this video I'm going to explore this strategy and see if it's all what it's made up to be. It goes by the name value averaging, so it sounds extremely similar, right? Well, today in this video I'm going to compare the differences between dollar cost averaging and value averaging, draw examples to demonstrate the differences, and finish off with my thoughts, and then actually reveal if I'm going to change my tack from dollar cost averaging over to value averaging. I'm even going to finish off by drawing parallels between the famous, or some of you might say infamous, Martingale Strategy, so stick around. Let me give a quick recap on what dollar cost averaging is. If you don't need this recap, then feel free to skip past this segment. I'll put a timestamp somewhere in the line below me here. If you do need a refresher, then feel free to like this video. And if you're really smart and you don't need it, then like this video. Sounds like a good deal. So what is dollar cost averaging? Well, for non-US viewers, ignore the word dollar. You can simply replace it with the currency that you use. So sterling, euro, yen, Bitcoin. You get where I'm coming from. The strategy is really simple. It's simply investing the same amount of money over the same time intervals. The amount of money in time interval can vary, but most importantly, it doesn't care about what the share price is, what it has been, or what it might do next. It couldn't give a monkeys. It's probably the most passive investment strategy out there, as once you've set it up, it just keeps on chugging along without any thought. Dollar cost averaging could be literally investing £5 a day, £35 a week, or £150 a month. It's the amount and the regular time intervals which are important, which is dollar cost averaging, nothing else. Usually this strategy aligns with your payment schedule, so if you're paid weekly, you'll dollar cost average weekly, and if you get paid monthly, then you'll dollar cost average monthly. What dollar cost averaging isn't is varying the amount of money that you're putting into the market or irregularly putting money into the market. This could look like not investing because you think the market is too high, or sitting there waiting for the fabled next dip. The reason why dollar cost averaging is so popular is the amount of evidence that shows this strategy gives you the best chance of getting the best returns versus other investment strategies. On top of this, it's the fact that it's such an easy strategy to follow. I'm not going to go into the research here, but I've covered it off in my dollar cost averaging video that I referred to before. The primary reason it works is, 1, your money is going straight into the market straight away, usually after being paid in a salary. As they say, your returns are normally based on your amount of time in the market and not timing of the market. And 2, the fact you're putting the same amount in each month means you're going to be buying more shares when the prices are low and less shares when the prices are high. It's really simple, meaning that you're automatically taking advantage of swings in the market. Right, so you now know what dollar cost averaging is, so what on earth is value averaging? It shares a few similarities with dollar cost averaging, but it's a lot more active in terms of how much energy you need to put into it. Let me explain. The principle of value averaging is to buy more shares when the prices fall and less shares when the prices rise. So it might sound similar to dollar cost averaging, but in this case you're actually investing more money or less money depending on what the market's doing. Value averaging starts with the investor calculating a predetermined amount that he or she wants in the market by a certain time period. So they're looking for a certain value of their investments in the future. So I want X in 1 month's time, or want this amount in 2 months' time, and so on. If your value at this given point falls short of the mark, then you'll top it up to this level. But if it's overshot it, then actually you don't need to invest any more money into the market. This future predetermined amount in the value averaging world is referred to as your value path. This all might sound a little bit odd, but it'll become much clearer when I have a working example for you to look at. So let me show you how it works. Let's imagine that your predetermined amount you want in the market increases by £1,000 each month. So by the end of month 1, you want £1,000. By the end of month 2, you want £2,000, and so on. You're buying shares of a company which are valued at £1 a share. In month 1, you buy 1,000 shares at £1. But when it comes around to month 2, the share price has actually risen to £1.25, meaning that your initial £1,000 is now worth £1,250. Your predetermined amount for month 2 is £2,000. So you're only going to invest £750 to top up your balance, that £2,000 mark, which will bring you to a total number of shares of about 1,600 shares. In a turn of terrible luck, the next month the share price has dropped all the way to only 80p a share. Your amount in the market at this point is £1,280, but your predetermined amount for month 3 was £3,000. So for month 3, you stump up £1,720 to bring up your balance at that £3,000 mark. This means you buy 2,150 shares to bring your total amount of shares up to 3,750 and the overall value to £3,000. In the final month, the share price has recovered to £1, bringing your total investment to £3,750, which means there's only a small gap to £4,000 which you wanted at that point, so you top up your account with another £250. If the share price jumped to £1.20 the month following, bringing your investment to £5,000, then by the laws of value averaging, you won't invest any further money, as the amount you've already got into the market meets your predetermined level or meets your value path. It's important to point out that if your investment actually overshoots your value path, then you're meant to sell down the outstanding balance. So if you had £6,000 in the market but actually only plan to have £5,000, then you'd sell down your position to £5,000. You could think of value averaging as a weird kind of buying the dip version of dollar cost averaging, which kind of works, kind of doesn't. If we use the same example but then use dollar cost averaging alongside it, we get the following results. I'm not going to take you through the workings as your time is precious, but if you want to look at the workings out, then feel free to pause the video and have a look through. The result being that dollar cost averaging has grown by £50 on a base investment of £4,000, but value averaging has grown by £280 and you've only invested £3,720, so quite a big difference. You might be sat there thinking, oh my god, I've been using dollar cost averaging for ages, how have I not known about this, what is going on? All I can say is take a chill, Bill, hold on cowboy, we're going to pod and proke this investment strategy and see how it stands up. There's a fair amount of assumptions made here. Let's start with the predetermined amount. Works well in this example as the answer is actually given to you, but where would you start in trying to work this out? How would you start? Let me give you my view. You would logically start with the amount you'd invest each month as part of a dollar cost averaging strategy. So if you're going to dollar cost averaging £100 a month, then I think this would be a reasonable starting point. But if you think about it, you wouldn't be able to put £100 a week into the market, because if the share price goes shooting down, you're expected to have a little bit of cash on the side to buy up to that level. As shown in the example, in month 3 you invested £1,720 due to the market dropping from £1.25 to 80p, which you wouldn't have been able to afford with the amount of money that you've been investing into the market. So the liquid cash flow required is pretty unpredictable, so you're going to have some sort of cash flow to one side that makes this work. In the future you might have access to more liquid cash if you're in a position where you've actually sold down your investment at one point as it's exceeded your value path. But let's say you haven't had the chance to make up this cash pile on the side to make this happen. Let's go back to the £100 example. So you go with £70, which means in each month your predetermined amount will increase by £70. There's no harm in that, right? This way you should have around £30 left over each month to start building a little bit of a buffer on the side. Well, one problem I have with that is, 1. What happens if the value of your shares keeps dropping and dropping? Are you meant to have unlimited money sat on the sidelines so you can chase the stock down? And 2, what happens if the market keeps on going up? Are you just meant to sit there and not invest any more money into the market because money's just going to pile up on the side? Well, you might say, Nick, the market can't go up or down forever in one direction. Yeah, you're right, but at what point do you change tack? All I can say is it's problematic and it isn't straightforward to unpick this. In this example I gave, it shows value averaging coming out on top, but I'm not going to lie, I'm incredibly pessimistic for several reasons. Outside of the massive liquidity issue you might face if your investment of choice falls through the floor, I think you equally have large red flags when it comes to your investments rising quicker than planned. As your money is sat there on the sidelines, inflation will be nibbling away at its value, when actually it could be in the market growing. As shown in my video on dollar cost averaging, when dollar cost averaging is pitched against the all-seeing God mode, where you buy the perfect dips between two all-time highs, dollar cost averaging still wins 70% of the time, which is incredible. It shows that time in the market beats time in the market most of the time. This strategy ultimately is trying to time the market to a certain extent. I've seen several articles claiming the power of value averaging, but in my eyes it's a false economy. By selling while you're ahead, you're creating an illusion that you're getting better returns. But the key factor here is that you're getting better returns on a smaller amount. Would you want 20% of 10 or 10% of 30? I'm sure you're smart enough to work that one out. It's very smoke and mirrors. Fundamentally, it's a lot more complicated than it seems on the surface, and you could face quite a few issues, with the main one being that you might lack the funds to take advantage of dips. For me, it reminds me a lot of the Martingale strategy, also known as the Martingale roulette strategy, which people claim you can use to beat the casinos. The Martingale roulette strategy is extremely simple. Place a bet on red or black on a roulette table, or if you're not familiar with roulette, then basically you're picking heads or tails when flipping a coin. If your pick wins, then you bet the same amount again, but if you lose, you double your original wager and go again. This way, if you win, you're only staking your winnings. If you lose, then you double your wager until you win, and then you've clawed all the money back that you've lost. Seems bulletproof, right? Well, just like value averaging, the Martingale strategy breaks down when it comes to liquidity. If you start with £1 and then follow this logic, if you lose 21 times in a row, then you would need £1 million to put on the table to recoup your losses, and that's even if you win that go. You might argue that losing 21 times in a row is extremely unlikely, and you are right, but by agreeing to this, you're saying it's possible, and that means it's probable if you play long enough. Anyway, these are only my thoughts. To clarify, I'm not a financial advisor, so if you're going to make any decisions, you need to do it all by yourself, as I'm not qualified to give investment advice. I'll pass it over to you. What do you think of value averaging? Do you think I've missed something, or is it something you found success with? Let me know in the comments below. I'd be really interested to see what you think. So, I hope you've enjoyed this video on value averaging and its comparisons to dollar cost averaging. But the main thing is, I hope you've learnt something. If you still have further questions or comments, then I'll try my best to reply to you in the comments below. I do other videos in this channel around investing, finance and income growth. These include updates on my investment portfolios, which most of you'll know that revolve around Vanguard. But I also have other investment portfolios, such as my crypto portfolio on crypto.com, so feel free to check them out. That's all for this video. See you in the next one.